Hi, I'm Jeff Bermet, and along with Nick Davis, we are the co-managers of the Libero Cautious, Dynamic, and Solutions portfolios. November is the kind of month that you just hope to survive and don't do anything foolish. The market was very volatile, huge intra-month swings in almost all equity markets. Ongoing concerns about the US government shutdown and that it was starting to materially impact the economy. It was settled in the middle of the month. Secondly, we had just ongoing worries about, is the Fed going to cut again or not? You had sort of similar noise out of other central banks. The Bank of England kept rates unchanged, and again, they just cited inflation hadn't progressed enough. And you had the awkward situation of equities dropping early in the month and bond yields actually rising, when investors would have hoped that bonds would have rallied to help offset perhaps some of their equity losses. The four big spenders in the US are looking at spending between $400 and $500 billion in 2026 on expanding their AI capacity. For most of the past, I would say 3 years since ChatGPT came onto the scene, the feeling was NVIDIA was the big winner. But now we've learned that Alphabet has been training their own AI model on their own TPUs, a different kind of processing unit, and it's getting a lot of good reviews from whoever reviews AI models. Meta has agreed to buy some of Alphabet's chips to train their own models on. And we're learning that Amazon has just released a new chip as well. So I think things are moving so fast in this space, so much money is being spent, that it's hard to pick any one company as the sole winner. So you have to have diversified exposure in this area. And fortunately, we do, and I think Nick will touch on that when he talks to you a little bit more. And then on top of that, you had a crypto, they're calling it the crypto winter or crypto meltdown. Bitcoin was about $125,000 a coin in early October. It got down to $85,000 a coin, maybe even a little touch lower at some parts in mid-November. What explains that? Hard to say. Other than there is enormous amounts of speculative leverage involved in the crypto space. But if people lose enough money in something, particularly if it's retail investors, it may make them shy away from risk-taking. It may make them pull money out of other financial assets to cover losses in the crypto space. So it's something we have to keep our eyes on. But I think, here we are in early December. It's time to start looking ahead to 2026. And I think there's three sort of spending initiatives that are going to keep happening and keep driving markets. One is clearly the AI spend. And these large tech firms in the US continue to believe that they need to have as much computing power as possible to train their models on as much data as possible so that they have the winning AI tool that everyone will use. And so we just do not see that spending abating, particularly because these firms can support most of the spending from their own free cash flow. I think the other thing that is happening is defense spending. Europe stands out because of their commitments that they decided upon early this year. The defense spending in Europe is going to continue. And the broader defense spending around the rest of the world in response to how war has changed because of drone technologies and other changes to what's happening in the battlefield is making defense spending around the world grow because countries realize the world is still very dangerous. And then I think the growing demand for electric power. Governments have been encouraging consumers to drive electric vehicles, to heat and cool their homes with electricity. And the world needs to produce more electricity, and they need to upgrade all the power grids, and they need copper to do that. And we still see mining and copper in particular as beneficiaries of this drive for greater ability to generate electricity and to move electricity around power grids. Behind all of this is a growing need for capital to fund all this. Now, I touched on the AI spend and that these companies can support a lot of it through their own profits, but not all of it. And so increasingly debt issuance is taking place in the AI space. Along with that, you have government spending that is just showing no signs of stopping. Until that changes, we still feel upward pressure on yields in the long end of bond markets as the likely result. And we think that demand for money by the AI spend, there'll be demand for money to spend on defense, there'll be demand for money to spend on electric grid infrastructure upgrades, makes us think that yield curves are going to remain steep, get steeper, and occasionally there will be months of indigestion in the bond markets, to say the least.
So as Jeff said, it's been quite an interesting month. Some of the positions we've held in the portfolios that have done very well over the year, we've seen a little bit of retracement in those positions. And Jeff touched on the AI spending, which we've talked about previously, and about concerns we've had about the exposure, and particularly around about the stocks like Nvidia. We've seen that with Samsung, which actually has been in our portfolios for over the last year, and actually in terms of performance has outperformed Nvidia this year. It's not in the same level of conversation people are having, but it's outperformed it. So has TSMC, the main chip foundry in Taiwan. Again, both these stocks have outperformed Nvidia over the year to date. And again, as Jeff mentioned, this is one of these things we've looked at in terms of the tech stocks, concerns about that, and we've taken that into account and reduced our position to the sector by selling Microsoft. So we still hold Amazon, Alphabet and Meta. And obviously with the news coming out of the new chip from Google, that's actually been really powerful, and Meta's also performed very well this month and had a big tech sell-off. So in a month of fairly difficult times, there have been some diamonds. Alphabet, as I mentioned, had a very positive month, supported by the news about its new chip, which has given people new hope and new views on that stock. The other area we've talked about pretty much infinitum has been financials and banks. And again, our holdings in European banks have performed very well this month and had very positive performance. We've expanded our selection of banks by adding a Japanese bank to our holdings this month. Defence, again, it's a key sector that we've talked about over the year, but what we are seeing now is the orders coming through into European companies, the process of those purchases being put through, the processes going through to actually get those orders underway. Whilst we think European defence companies are going to be one of the key beneficiaries of this, the US defence companies will, particularly through the F-35 fighter, is a key beneficiary of this European spending. So there will be money being spent with the US. So commodities, we've talked about commodities, and in solutions and in cautious, the gold position has continued to do well. The other area we've had is obviously exposure to copper through our mining ETF and also through the Anglo-American position. So we're still happy with those positions in mining and look forward to seeing those come much better in the year ahead. So it's been a fairly difficult month for the funds. Cautious has done its job, come through positive. Solutions and IMEC slightly down in the month, but given where we've been over the year and the rise we've had, no, still a good year for the funds so far. So thank you for your support, and we look forward to catching up with you in the new year.